Kia ora, and welcome to Shared Lunch. My name is Susanna Batley, and I'm at Channel Infrastructure's head office here in Auckland. I'll be joined by Rob Buchanan, the CEO.
More than ever, energy security, fuel security is really important to economic prosperity.
Channel Infrastructure was once an oil refinery, and it's going through a major transition.
There was a really significant opportunity to build a real future for the company and bring back much more, hopefully, than what was lost when the refinery was closed.
It's got a big, bold vision to become an energy precinct, powering New Zealand's future energy, resilience and decarbonisation.
We've got a really awesome opportunity to be transformational for Northland and New Zealand. That could be 20,000 jobs, a significant contributor to GDP.
Before I head upstairs, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Rob.
Thank you, Suze.
I should probably say thanks for having me here at your premises.
We're delighted to have you. Thank you very much for giving us your time.
So I'm keen to start by zooming out a bit and hearing a bit more about some of the big energy changes that are happening in New Zealand. And then in particular, what are the challenges and opportunities and how Channel might be uniquely positioned to either solve for those challenges or take advantage of those opportunities?
I guess I'll start with the really big picture, global context. We're finding ourselves in a more contested environment, and I think more than ever, energy security, fuel security is really important to economic prosperity and everybody having the certainty that they can get on and invest in what they're doing in New Zealand. And so Channel's really able to provide or help provide that fuel security piece. It's a core part of what we do. We store over 300 million litres of petrol, diesel and jet up at Marsden Point. And we're currently in the process of bringing in place additional storage. We've got another 350 million litres of empty tanks up there that we can convert, which we've got quite good at. And that obviously adds to overall New Zealand fuel security. I think one of the other challenges as we've gone through the energy transition, trying to transition to a renewables electricity system, has been that firming capacity or generation that can come on or off at short notice when the sun's not shining or the wind's not blowing and it's not raining, which it has been doing a lot of lately. And that's another area where Channel can play a part. So we're looking at a diesel peaker at the moment. If all of our fuel tanks at Marsden Point were full, we'd actually have as much stored energy up at Marsden Point as you would have in Lake Pukaki in the South Island. So huge amount of stored energy and the potential for that to just firm that electricity system or add to that firming.
And in terms of that firming and so the amount that might be required to support the sort of largely renewables in terms of energy generation in New Zealand, do you see that sort of going down as we're bringing on more renewables, or on the demand side, obviously the demand for electricity is going up. We've got AI, we've got data centres that support that, we've got electrification of automobiles and sort of other industrial plants. So how do you think about that sort of supply versus demand and what that firming profile might look like in the future?
Well, there's no question in my mind that demand for electricity will continue to grow, and like data centres is a classic example. They use a lot of electricity and they use it 24/7. And so the challenge for us in New Zealand is matching up that 24/7 usage of data centres or manufacturing that just needs to be able to turn on and have the power available to use at a cost-effective price, is that our system is actually quite renewable. And we've got, it's fairly well known. I think most people know that gas is declining in New Zealand. And so that used to be the fuel that plugged the gap. And now we're relying on coal. And there's only so much coal-fired capacity in New Zealand as well. So that's where we see, diesel peaking or maybe other forms of gas peaking as being an opportunity to switch on, make sure that the power's there when folks need it. But ultimately, hopefully over time, the New Zealand electricity system fully renewabilises and the need for that firming won't be as great.
If that is the case, what happens to your role sort of as part of that?
Well, I think at the moment, the way we're thinking about the diesel peaker option for our site is that it's there for as long as it's needed. And we'll see how long that is. One of the options we're looking at is containerized units so that they can just be brought in across the wharf, across the road, planted down, probably turned on for very short duration during a year. And then if we do get to a point in our system where it's no longer required, then those units can go back offshore and we can get value for them. I think from Channel's perspective, the way we interact with our customers, one of our key requirements is that we have long-term contracts, and we're not an electricity participant. We have no electricity trading capacity. So, that project would only get developed and built if there were other parties in the electricity sector that would basically take that capacity off our hands.
Yeah, de-risk it.
Correct.
Yeah. So in terms of customers then that you mentioned, who are they?
At the moment, our three key customers are BP, ExxonMobil and Ampol. And you'll have seen also that we will soon be welcoming Higgins to our site as one of our newest customers of the new bitumen import terminal as well.
You're clearly needing to balance a lot of stakeholders. I'm sure there's quite a lot of health and safety things to think about with your employees. Yeah. So how do you've got shareholders, obviously, as a listed company. So how do you think about balancing those different stakeholder interests and how you're making sure that you're generating a good shareholder return while also making sure that from a New Zealand Inc. point of view, that you're also fulfilling that role as well?
The way I look at it is that they're all very important. You mentioned health and safety. It's absolutely core to what we do, and getting everybody home safely every day is a core value for Channel. And if I zoom out on health and safety in general, the role that we provide in that fuel security piece means that we need to have a safe and resilient operation as well. Obviously our customers are a key stakeholder, and we spend a lot of time with them making sure that we can service their needs. The government's obviously very interested in what we do, and shareholders obviously as well. So, a very broad set of stakeholders, and I think as a company we're really privileged to be able to interact and serve all of them.
In terms of those current customers and then future ones like Higgins as part of Fletcher's coming on board, you have talked about this transition and this new vision of an energy precinct.
Yeah.
Can you talk a bit more about that, and particularly why now? Why is now the right time for that transition?
On 1st of April 2022, we closed the refinery and we converted to an import terminal. And upon that closure, the key assets that I think last year we earned $95.1 million of EBITDA. The key assets that earned that were effectively the tank farm, the port that we operate, and the pipeline to Auckland. Now, those assets cover only 30 or 35% of our 180 hectares of land that we've got up at Marsden Point. So it's part of that transition and reinvention of our company into a new business. We thought long and hard about what the alternative and highest and best use for that land is. And if you look at the characteristics of the land, so we're adjacent to a port or our jetty, which is actually currently only really 35% utilised. So there's a significant amount of capacity in our jetty. The land itself is only around 35% utilised. So we've got a significant amount of land. And we've got a pipeline all the way to Auckland. So if you make a product and we can get it into that pipeline, we can get it all the way down into the heart of industrial New Zealand. In addition to that, we have very attractive resource consents for fuels manufacture, which persist for 35 years from 2022 when they were reissued, or 2021. And we've got a very attractive zoning package. So the zone that we sit in is actually literally called the Marsden Point Energy Precinct. And so when we looked at all those features, we realised that there weren't very many places in New Zealand that you could build for example, a bitumen import terminal or a renewable fuels manufacturing site or additional fuel storage, and that there was a really significant opportunity to build a real future for the company and bring back perhaps much more, hopefully, than what was lost when the refinery was closed.
And in terms of that capacity that you've got, both in the land and in the pipeline, what does an ideal customer look like? Like, presumably you're talking to other potential customers, like Higgins.
Yeah.
What makes an ideal tenant or customer of the site?
The first comment would be, well, we've got a lot of empty crude tanks still, so we would love customers for those for our core fuel storage business.
Yeah.
And obviously we've got existing customers that might have interest in those. I think the thing I'd speak to, and we've spoken about publicly, is the Biorefinery project with a consortium of Seadra, Qantas, who will be well known, Renova, who are Japanese renewable electricity and fuels manufacturer, ANZ Bank and Kent, who are working to repurpose some of the old refining equipment into a biofuels manufacturing facility. And if you think about, there's a few things, a few reasons why that would be really epic for both our region and New Zealand. Firstly, biofuels are manufactured from feedstocks which tend to be local. So whether you import crude into New Zealand or you ship crude into Asia and refine it and bring it down in a boat, you've still got a feedstock that's got to transit international waters, which carries risk. The great thing about biofuels is you can manufacture them from domestic feedstock. So all of a sudden you've actually got your own self-sufficient fuel industry, which is fantastic for fuel security. Obviously, there's a hell of a lot of jobs and economic growth and investment associated with that facility. Should it go ahead, it would be incredibly large. Channel's expertise today is in the management of a high hazard facility and in fuels infrastructure. And our shareholders invest in us for the regular dividends and the long-term contracted returns we're able to provide them. And so our role in this project is, if you like, enabler. So, we've got a big piece of land and some ex-refining equipment that we can provide them and earn, steady rental income on. We've got some empty tanks, which I think they'd, like to use for their project, which, we can earn revenue from, and we've got a jetty and a pipeline in terms of getting that product in and out. So I think from our perspective, we're being quite careful about where we play in these new projects. We're not here to expose shareholders to a significant amount of development risk. We know they like investing in us because of those long-term stable returns, and that's the position we've crafted for ourselves.
Is that helpful now with, I guess, some of these bigger opportunities that probably do require significant capital expenditure? You did go back to the markets last year and raise 50 million, but some of the quantums on some of the projects are a lot more than that. How are you thinking about funding those versus a regular dividend that maybe shareholders expect now? And is that the right capital structure that sets you up for success, for this growth?
So at our annual shareholders meeting, we talked about actually increasing our dividend payout ratio. So, we're very committed to those dividends. And I think the capital raise we did last year was extraordinarily successful. In fact, I think I'll get the stats wrong, but it had one of the highest take-ups for a rights issue structured in that way ever in New Zealand. And fundamentally, the reason that people, I think, backed us for that is, the projects that we brought forward. And if I take the jet tank or I take the bitumen import terminal facility, largely the fees that we earn on those are capacity based. So we're not taking a significant, you spoke about development risk before, we're not taking a significant amount of operating risk associated with those assets. The risk follows the parties that are best able to manage that risk, which is generally our customers. And so from our perspective, we're playing to our strengths, which is management of a high hazard facility and long-term infrastructure. And we're letting our customers and partners play to their strengths, which is management of the product that they ultimately want to get into New Zealand, store and distribute to where it needs to go. So I think from my perspective, I think shareholders are attracted to that type of model. And I think as long as we stick to that type of model, I'm really confident that we can raise the capital that we need to fund these projects.
And on those contracted revenues and contracts that you enter into with the customers, with the move of shutting down the refinery, revenues less dependent on fuel volumes. But what does that do to the potential for upside? So it's great at protecting the downside risk, but where is the upside for equity returns?
Yeah, so I think the way I look at the business is we've got this core defensive infrastructure business with long-term contracts with our customers, and that's in a place where I think we're up to, roughly 50% of our revenue last year or this year, is fixed, so not dependent on volume throughput. And I think investors take a lot of comfort from that. I think the upside comes from our ability to deliver the growth projects. And so last year we committed to 55 to I think 65 or 62 million of new growth projects that were at attractive returns, and that is the bitumen terminal and the tank that we're talking about. And we've spoken this year about and in this conversation about some of the other projects that we've got, growth projects that we're working on, like the capacity-based diesel peaker, like the Biorefinery project, where we're able to, in a really smart way, use our existing assets, use our existing land to provide additional revenue and returns to shareholders. But the returns and revenue associated with those deals are likely to be the same contracted capacity-based type deals that you've seen from us in the past, because we know that shareholders like them. So that's one part of the upside. I think the other for us is, over the course of the past 18 months, 3 of our major shareholders sell down, the 3 customers actually that we have, which is a legacy they had when we were a refinery. And that to me speaks to their discipline about recycling capital, and we see an opportunity for us to help them recycle capital in other terminal assets they might own in this part of the world as well. Because we're not the only terminal in New Zealand, there's a bunch of others. There's one actually just downstream from us, and so from my perspective, we're here saying we've got capital to invest. We're a good owner and manager of these assets. That's why customer relationship piece is so important, and we can take a long-term view and allow our customers to reinvest their capital elsewhere in their supply chain.
Your background is that you've headed up M&A for a large investment bank. Outside of maybe those terminal assets, is there any other sorts of assets that could be quite attractive, particularly because of maybe capabilities, expertise, other sort of assets and experience that Channel might have that they could leverage?
Yeah, one of the lessons that I've learned from doing 20 years of M&A is you need to look really long and hard at what your own capabilities are as a business, and ask yourself, can you actually manage what you're buying better than the person that's selling it to you? And I think in relation to terminals assets, I think we manage New Zealand's largest terminal by a country mile. We've made some really good operational improvements over the last couple of years. Really proud of the way the team's delivered that. And I think, that's earned us the right to say, well, we are really good owners and managers of those assets. And so I think we're pretty disciplined about the types of assets that we'll look at, actually. And I think focused on those where we can add value as a management team and as an operator, and sticking to those. Now, it might be in the future that we build additional capability and we say, well, hey, we've got a capability that we can go and export, or, there's an asset that comes with a team that has a great capability. But I think for the business as it stands today, that's really our focus.
So it's really asking the question, are we the highest value owner of this asset?
That's right.
Not just trying to get a bargain for a sort of random asset that might not be so strategically aligned.
You shouldn't and you can't do M&A for M&A's sake.
Yeah.
You do it because you see it gives you a competitive advantage as a business, helps solve your customers' problems, in our case, and that most importantly, we can add value to shareholders. And if it doesn't tick those boxes, then, we shouldn't be doing it.
Yeah. So you did mention that 20 years experience doing a lot of different M&A deals. Was going into an executive position always part of your plan, or was that more sort of an opportunity that came up?
I think if you want to be really real about it, I don't think becoming an investment banker was ever part of my plan. I went to university to study computer science, took one finance course, and almost by accident just kept going. And when I finished university, most of the cool kids were trying to get internships at banks and those types of things. So I just did what everybody else did. So from my perspective, I found myself 20 years into an investment banking career. I think one of the privileges of that is that you work with companies in their best moments and in their worst moments. I saw a lot of really good decisions and I saw some not so good decisions, and you learn a lot from that. I think personally, I'd achieved a lot in that part of my career, and I was kind of ready to move on to the next thing. And actually, the role, well, the two roles that I've had since I transitioned out of banking have both been with really good clients. When I was working at Forsyth Bar and moved on to Manawa, they were a client at the time, and I knew that business really, really well. So I think that helps with that familiarity. But yeah, I think I wouldn't say it had always been part of the plan, but certainly increasingly it was part of the plan. And I'm really excited by what I'm doing now.
You talked about seeing both good decisions and not so good decisions. A key part, I imagine, of being a CEO is that you really have to live through the consequences, both good and bad, of those decisions.
Yep.
What has been some of the biggest learnings you've had as you've made that transition from advising to sort of, seeing the consequences, both good and bad, of any of the decisions that are being made?
Having a really good team around you is everything. And having a team that aren't afraid to put their hand up when they think you're making a bad decision or we're not heading in the right direction. And so, what I really value about our team at Channel is everybody is upfront and straight up about what they think, and we have really good discussions about all the decisions that we make. That healthy culture of challenge and debate leads you to making really good decisions. And so for me, being surrounded by super smart people who are passionate about what we're doing, passionate about the mission, want the best for the company, and each bring different perspectives to a decision, whether it's operational, financial, strategic, commercial, risk, and each bring that lens. From my perspective, I think that's how we make good decisions as a company.
And as you say, when you do have those diverse opinions, it's almost impossible to get consensus straight away.
I almost worry if everybody agrees with something, because it makes me wonder, have we really tested this, right? And so, that's why a really diverse team of talented people is such an important part of a high-performing business, and people that are unafraid to, provide their opinions, good fact-based discussion, and ultimately contribute to the success of the company.
So in terms of that success of Channel infrastructure, if we fast forward 5 years or maybe even 10 years and things have turned out really well, what does Channel infrastructure look like?
Well, we've got a really awesome opportunity to be transformational for Northland and New Zealand, as I said. So the development of the energy precinct, I think you've seen the numbers, during the build phase, that could be 20,000 jobs.
Just massive for 15 years.
For over 15 years. It could be over 1,100 jobs on an ongoing basis, a significant contributor to GDP. Depending on the projects that we can bring to bear, we will be really additive to New Zealand energy and fuel security, because that's what the energy precinct is designed to do. And, I think if we did that, for Northland and New Zealand, that would be epic. That would be just such a great outcome. And we're, the energy precinct is a long-term plan, and there'll be ups and downs and projects that happen and don't, but I think we all see the potential there, and the awesome economic potential for Northland, and the awesome, opportunity for that energy and fuel security piece. The other comment I would make is that my hope, certainly within 15 years, is that we aren't just based at Marsden Point, or don't just have assets at Marsden Point or Auckland, that we're a bigger company than that, and we've got a bigger footprint.
That precinct is a real long-term investment. Some of the numbers are, got big scale. I think PwC estimated about $2.3 billion contribution to the GDP that might make. Things around us are changing all the time, and it feels, if anything, like the rate of change is getting faster, not slower. How do you think about building a long-term strategy, and particularly one where it does require significant capex up front, when things change so much?
Yeah. Well, firstly, that's why partners are really important. I think we need to be really humble in New Zealand that we won't have all the right ideas and the solutions. And there's a whole bunch of really big companies and some small companies out there in the world doing some really interesting things in this space, and we need to bring their expertise and capital as relevant. So, I think that's part of how we de-risk this for Channel and our investors. So from my perspective, partners are key to that. I think being willing to be patient and pivot as well. As I said, this won't be a linear journey. And, probably 2 years ago, did I think that, we would have need for a diesel peaker on the site, or that might be something that New Zealand would need?
Gas market kind of disappeared, didn't it, overnight?
Correct. And so I think you've always got to be scanning on the horizon. Where are the opportunities? How can we contribute as a company? What is our unique competitive advantage that we can bring to something? And who can we partner with to help make it happen? And, if it happens, that's great. And if it doesn't, then, maybe it sits there for 5 years and it happens in 5 years, or maybe it pivots to something else. I mean, if you think about, the Biorefinery project, that's the ultimate pivot, because we're turning what was some old refining kit into something that is new and, could make a really significant economic contribution to New Zealand.
If you were an investor thinking about Channel Infrastructure as an investment, what would be the metrics that you would be looking at? We talked about dividend, so dividend yield is one,
yeah.
But what are some of those other metrics that you would think about tracking over time to assess whether Channel Infrastructure is being well run and doing well?
So the measure that I would look at, so there's dividend and free cash flow, right? And the reason that free cash flow is so important, and actually you look at it across any business you invest in, not just Channel, that is a true measure for the cash that the business is producing.
Yeah.
And so, EBITDA can have, when people talk about revenue and EBITDA, there's pros and cons with those measures, but free cash flow is the earnings less the sustainable capex, less your interest costs. So, it's a true measure of the cash that the business is producing. And I think shareholders should look at that. I wouldn't want to give anybody any financial advice, but I certainly look at it at any investment that I look at, not just Channel. And that's a metric that we are focused on as a company, because, we need to balance, the long-term nature of our business and making sure that we make good, disciplined investments in our assets to ensure that they're there for, a very long period of time. So that's covered in the capex part of it. And then there's the earnings part of it, or the cash that the business generates as well, which is a reflection of, the enterprise or the job that we do.
Well, I think we're at time here, but thank you so much for what has been a really interesting conversation.
Thank you, Suze. Really appreciate it.
Thanks for tuning in, everyone. You can get Shared Lunch on YouTube or wherever you get your podcasts. Leave us a rating and let us know what you'd like to hear about next. Have a good rest of your week.